From the Cube studios in Palo Alto and Boston, bringing you data-driven insights from the Cube and ETR. This is Breaking Analysis with Dave Vellante.
Investors, they keep score with growth rates, but this quarter you had to read through the footnotes and the fine print when it came to cloud. Microsoft, man, they put up eye-popping Azure growth yet again. But a big slice of that acceleration is from AI inference, particularly ChatGPT, which is now embedded in the revised Azure definitions. It's great for headlines, but it's not necessarily conducive for an analyst to do apples-to-apples comparisons with AWS and Google Cloud Platform. Meanwhile, AWS continues to deliver the biggest dollars in a very clear message that their demand exceeds supply, meaning growth is capped by things like power and components, not pipeline. So that creates this sort of weird optics penalty. AWS showing growth in the high teens on a 120 billion plus run rate. That's a concern to investors, but it also telegraphs future upside as capacity lands and depreciation cycles go through their cadence. The quiet story here, sort of stealthy, is Google posted really strong earnings print with the solid top line growth and increasingly improving operating margin. And GCP, the piece that they really don't give much guidance on, that's the IaaS and the PaaS core. It's growing materially faster than cloud overall. In our view, the estimate is it's almost 40% growth, which is significantly higher than Google overall cloud. Now, their backlog is also building. They've got a $250 million backlog, and they're doing billion-dollar deals. Those are real now. So as the mix shifts toward AI-heavy infrastructure-centric workloads, it becomes a tailwind. The AI becomes a tailwind for Google. Now, it continues to lag the scale of AWS and Azure, but it's a more disciplined scale strategy, let's call it, with less noise. Now, the other common thread is that the CapEx arms race, this just keeps going, and it's facing real constraints. All three players said, the quiet part out loud, that power, real estate sites, data center sites, servers, just energy and lead times are going to dictate kind of who wins this AI inference race and training and who can monetize it first. Microsoft is capacity constrained. AWS said it's going to take several quarters to rebalance, and Google raised CapEx yet again. So this is not a one-quarter story. It's a many-year land and power grab and expand that's going to determine margin structures for the next cycle, i.e. decade. Meanwhile, the big three cloud players, they're on pace to spend about $240 billion this year on CapEx. Now, AI revenue is only coming in at about 10% of that figure. So we clearly have a big hurdle before that massive investment pays back. The bottom line is growth rates, they matter, and there's little question that Microsoft's business is humming. But the GPT-5 launch, which happened today, is going to accelerate growth and further pressure costs. Meanwhile, Microsoft's own attempts to build in-house foundation models points to a pending transition that'll make the browser wars look like kiddie sports comparatively. Hello, and welcome to this week's theCUBE Research Insights powered by ETR. In this breaking analysis, we're going to update you on our latest take on the cloud infrastructure market. We're going to take a fresh look at growth rates. We're going to put those in context, sort of peel the onion beyond the headlines. We're going to share market share projections for the year and our puts and takes for each of the big three. And then we'll weave in some spending data from ETR and finish with a look at the road ahead. So here's the quarter at a glance. The big three U.S. hyperscalers, they just printed roughly $60 billion of IaaS and PaaS revenue. All in, that IaaS PaaS revenue grew about 27% year on year. And that's about a 1-point acceleration sequentially. As I said, demand is still outrunning supply. Margins diverged. AWS came in at around 33% operating margin, down from 39% last quarter, as depreciation and the seasonal stock-based compensation hits took its toll. And of course, this is an ongoing capacity pinch that all the players are facing. Google Cloud kind of moved the other way to roughly 21% operating margins, up from 18% last quarter and 11% a year ago. So Google is finally making some steady yet quiet progress and is executing. Microsoft kept hiding its operating profit, for cloud, but when you dig into their 10Q, you can find some data. But they did give us a lot of hints or more hints or actual disclosures on Azure. Microsoft Cloud revenue was almost $47 billion. That was up 27%. But gross margins were down 2 points at 68%. And that's because AI infrastructure scales. Azure is less margin accretive, or it's margin dilutive to Microsoft's overall margins. And as the mix shifts toward lower margin infrastructure, that pulls margins down. But for the first time, and that was gross margin at 68%. For the first time, they put a number on Azure, $75 billion for the fiscal year, which ends. Remember, Microsoft's fiscal year ends in the June quarter. So, but you got to also remember the definitional changes that Microsoft initiated last fall, and the AI inference boost that they're getting from ChatGPT kind of muddle these apple to apples comparison. We'll dig into that a little bit, but CapEx is the real story. You take the big three plus Meta, they shelled out about $87 billion in the June quarter. So, and by our math, 75% of Amazon's CapEx is for AWS. So that's sort of, we're adjusting for that. And that sort of underscores the supply buildup. The bottom line is Azure's AI pop is real, but it's fattened up, if you will, like a calf by inference. AWS is constrained, but they're investing through it, and Google is quietly, widening its margins while it scales. So let's take a look at some of the key performance indicators. And maybe we could do a quick scan of the metrics that we're tracking, at least some of them that we think matter. Microsoft Cloud, as I said, was almost $47 billion, up 27%. Its intelligent cloud segment was almost $30 billion, so that was 26% growth. And then Azure and other cloud services up 39% year on year. That's in constant currency. So our estimate is that the Azure, IaaS, and PaaS business is $22.2 billion. So we mapped to that $75 billion figure in our quarterly numbers. And then we have AI services, Azure AI services at $3 billion. Remember, Amy Hood normally each quarter has given an indication as to how much of the Azure growth, what portion of the Azure growth came from Azure AI services. They declined to do it this quarter. We had it about 19% up from last quarter's, I think 16, 17, or 16%. So almost 20% of that growth comes from Azure. And then management, again, says demand exceeds supply well into the first half of fiscal year 2026. And their CapEx guide for Q1, which again is the September quarter, was $30 billion. So pretty substantial. AWS did $31 billion almost. That's 17.5%. We had them at 17% and change. And so that's year-on-year growth. That's $124 billion annual revenue run rate and a 33% operating margin. So as I said, it was pressured by the stock-based compensation, the higher depreciation, and they faced currency fluctuations as well. Actually, that's included in that figure. So that actually should be a benefit to AWS because you're taking international dollars and bringing them back into depreciated US dollars. So that should be a tailwind. We put AWS's AI services at somewhere around $2 billion. They don't really get guide on that. They talk about multi-billion dollar, AI pipelines and things like that. We're guessing it's around $2 billion. They had a $195 billion backlog, and their CapEx was pretty heavy. $24 billion, we estimate, of Amazon's $31.4 billion in Q2 was for Amazon Web Services, as opposed to things like warehouses. So as supply constraints are expected to ease over several quarters, we could see those growth rates pop up. And we're going to see, we think, the same with Azure because of GPT-5, and we'll come back and talk about that. Google Cloud put up almost $14 billion, $13.6 billion. That's 32% year-on-year growth with a 21% operating margin. Our estimate is that GCP, which is the IaaS and PaaS piece, was $7.2 billion, and it grew much faster than Google Cloud overall. So we've got that growing at almost 40%, about 39%. And we've got their AI services component of that. The contribution from that is about 600 million. So still kind of catching up to the other big guys. CapEx, though, was 22.4 billion in the quarter, and the 2025 outlook for Google is 85 billion, higher again in 2026 is what they guided, and they got a backlog of 106 billion. So they are as well are capacity constrained. So with that, let's run through the pluses and minuses for each player, and we'll start with Microsoft. The Azure, it's ripping, 39% growth. Management guided to 37% constant currency next quarter. Even though they're capacity constrained, we think it's actually going to be much higher, maybe even as high as 40% with GPT-5 kicking in. They have a $368 billion remaining performance obligations, so that's up 37%. So you got a runway there, and the whole Foundry and agent usage is surging. They talked about, token throughput. So Microsoft has found a real AI platform flywheel. There's no question about that. We wrote about it, and we're actually, very high on the company, despite the fact that, they are playing games with the numbers a little bit and not making it easy for doing comparisons, but the business is cranking. Also, software efficiencies are kicking in. They said, quote, 90% more tokens per GPU were delivered year on year. Now, without this, the gross margin drag from scaling AI would probably be a lot worse. Now, the other positive from the Microsoft print is they finally announced $75 billion in the year. They said they did more than $75 billion. The only other disclosure we've ever had on Azure was from the leaked court documents from the Activision trial, which we reported on. The negatives, Microsoft, they're still not talking specifics on cloud operating margin, although you can get it in the 10Q, and we'll share that. In fact, the previous chart, I think, had that at around 41.4%. Yeah, so that came right out of their recent 10K. But overall, Microsoft Cloud gross margins fell 2 points year on year, and that's pressured by the AI at Azure, or Azure's AI mix. So the more AI they do, the more expensive it is, the lower margins are. But Microsoft's got such a great business, it almost doesn't matter. They said supply remains tight. This is the continuing theme. They said through first half of 2026, which implies some demand is still being pushed out. And a big piece of Azure's momentum, as we said, is tied to the ChatGPT inference. And, of course, the definitional changes that we reported on last fall. So, and they mess with the growth rate versus kind of the history. For AWS, just a quick read there. The pluses, it's still the revenue leader, although that lead is shrinking. It's got 33% operating margin. It was up in the high 30s last quarter. Even after that big depreciation step up, they still remain profitable, which essentially is a company that sells access to hardware resources. And like the others, demand exceeds supply. They got a $200 billion backlog almost. That's up 25%. And their AI stack, it runs deep and wide. They got Trainium 2 kicking in. They got Bedrock. They got Agent Core and Kiro, which they announced at the New York City Summit. So Agent Core is designed to be the place to simplify, the building of agents for developers. Kiro is an IDE that's, simplifies, more simplification of development. I still, I had an argument with John Furrier about this. I think it is somewhat of a low-code environment, although it's more than quote-unquote vibe coding is what AWS is emphasizing. But the other thing is AWS has this vast ecosystem that gives the company and its customers a lot of optionality, and they've got a really good, strong full-stack leverage. The negatives, the headline growth of 17.5%, the fact is, it does trail Azure and it trails GCP. We'll double click on that. And it does invite what I'll call lazy comparisons. And that's what we saw when Amazon announced its quarter. The stock dropped, even though it beat on the top line. It beat on the bottom line. As guidance was solid, but everybody said, oh, well, it's way lower than AWS or Azure and GCP, so it must be a negative. So let's face it, AWS is getting out-marketed right now by Microsoft, and maybe they don't care. AWS has always said it's comfortable being misunderstood, so it's definitely, I think, Wall Street analysts misunderstood that print. But they got heavy CapEx, which means more depreciation, and with capacity expected to rebalance over what they said, quote, several quarters, the near-term upside, could be capped. I think it's there. It's like a coiled spring waiting to take off, but there are constraints. All right, let's take a quick look at Google. The pluses: Google Cloud is hitting this kind of nice combo of scale and profitability, 32% growth, 20.7% operating margin, and GCP, IaaS and PaaS plus AI is growing, as we said, much faster. Our estimate from the Cube Research is 39% versus the 32% overall growth for Google Cloud. They got backlog momentum. That's real. $106 billion in backlog. They got $250 million plus deals that have doubled, and they got $1 billion wins that they're touting in the first half. So multiples of those, which match all of 2024. The negatives, again, they're capacity constrained into 2026. So that's going to pace their revenue recognition. And Alphabet flagged an acceleration in depreciation as CapEx, explodes. So those are both potential margin headwinds. And then the disclosure on pure IaaS and PaaS, it remains opaque. And so we're relying on qualitative signals, statements that Google makes relative to cloud overall, and of course the survey work that we do on our own and with ETR. So, that makes it somewhat challenging to nail this stuff, but that's what we do for a living. All right, let's zoom out and take a look at the annual market share forecasts. Cloud infrastructure is now a $250 billion market. So in 2025, the big three plus Alibaba are going to clear $258 billion. That's up roughly 26% year on year. As I said, AWS is the revenue leader, but its growth is well below Microsoft and GCP, which are both running in the high 30s. Azure is the big story. Almost, closing in on $90 billion in 2025 for IaaS and PaaS. And that growth is juiced by AI inference volumes from ChatGPT and Microsoft shifts in what counts as Azure. Remember, they redefined Azure definitions. GCP's solid number 3. They're talking about a $28 billion business, and everybody sort of dumps on Google because they're a distant number 3rd. But that's there are not a lot of $28 billion businesses that are growing at 39% out there. So it's growing, roughly as fast as Azure from a much, much smaller base, of course. And the share shifts are obvious. AWS keeps dropping, 4 points in this little model of ours of IaaS and PaaS share since 2024, down to below 50%. Microsoft is picking up points to about 35%, and Google, is hanging in at about 10%. But if you look at it differently, if you look at Azure plus GCP, they're growing at a combined 38% versus AWS, which is just under 18%. So that's a gap that we continue to watch. And then underneath the revenue is an unprecedented CapEx cycle. It's just, some people would think it's insane. But these smart people hopefully know what they're doing and have visibility on, the long term. And of course, they have the cash to pay for it. The big three are on pace to pour roughly $240 billion a year into data centers and power and cooling and servers and storage to feed that AI demand. But 2025 AI services revenue is on the order of $25 billion. So you got almost $250 billion in CapEx, and you got $25 billion in AI revenue, which means a lot of front loading. So big spend now for monetization that in theory scales later. But bottom line is AWS still throws off the most bucks. Microsoft's, new definition plus the injecting AI strategy is definitely helping him gain share. And Google just keeps quietly compounding with evidence and improved profitability. So much for a winner takes all. These three companies are all well positioned in our view for the AI era, and they will get their fair share. All right, let's look at some of the nuances of interpreting the numbers and the growth rates and the games vendors play with numbers, and particularly Microsoft here. The Azure revenue trajectory has been remarkable. We can't take that away from it, and that's shown in this chart. Entering COVID, our estimate was that Azure was generating about $4 billion a quarter, And today our estimate indicates that Azure is running at more than 21 billion per quarter and growing in the high 30% range. So note that revenue flattening in 2024, and that roughly coincides with the removal of those legacy slow growth or no growth or declining businesses. Enterprise mobility was in there, security, and I think Power BI per user pricing revenue. They took that out, and then they inserted AI revenue when it was relatively small. So what that did effectively, they didn't announce this, but our model showed it. When we made that change, it lowered the absolute dollars for Azure, but of course it made the growth rate accelerate. Of course, Microsoft reported the growth rate because they're smart marketers. They never talked about the absolute number until recently. So you can see in this chart, it steeply rises. The revenue into AI services kicked in. Like Microsoft, they timed this beautifully. So they make the change. They announced the growth numbers last fall. They up them. Makes it sound good. They don't talk about the absolute dollars, and then they disclose it at the end of their fiscal year that it surpassed 75 billion. So that's a meaningful number. It's growing very rapidly. So again, Microsoft's fiscal year ends in calendar year Q2, and that $75 billion figure roughly corresponds to the calendar year periods we show here. We've mapped to it. So they've cleverly timed their reclassification of Azure revenue and the $75 billion disclosure to really hammer home its substantial revenue base and its significantly higher growth rate relative to AWS. But, this is the growth optics slide, i.e. the games people play. And the chart at the bottom of this tries to put everybody in the same field. So AWS did almost 31 billion in IaaS and PaaS in the quarter. Call it 30 billion because you can take some revenue. Maybe that's like 1%, maybe it's $1 billion. So with that 17.5% growth, the optics don't look great. But when you map to that $75 billion figure from Microsoft, you get 22.2 billion and 39% growth. But if you take out the ChatGPT uplift and Microsoft's definitional tweaks, if you put those back in, it would be actually really interesting to compare. But let's use the new definitions. The core Azure business is somewhere between 18 and 19 billion. If you take that out, it's growing in the mid 30s. And at that size, when AWS was 18, 19 billion, it was also growing in the mid 30s. So the meme that AWS is lagging is mostly attributed to rate of change drama. When you go back in time and look at AWS's growth back when they were that size, it's comparable. You could even, if you go back to the old Azure definitions, Microsoft would be growing at 20%. So you can see the kind of games that they're playing with the numbers. Google Cloud Platforms of 7 billion, just over 7 billion, growing it in the high 30s, 38, 39%, very strong. But consider this, when AWS was at 7 billion, it was growing at 45%. So this isn't unprecedented hypergrowth. So the net is that the market is ripping. But a lot of Azure's pop is AI inference optics. George Gilbert points out that Microsoft, they don't want to highlight the fact that they have a ChatGPT tiger by the tail. Probably 50% of OpenAI's revenue goes to COGS, i.e. directly to Azure fees. And the point is, strip that out and the growth curves of AWS, Azure, converge, somewhat when normalizing for the size of business over time. But we are in the AI era. So it's perfectly valid to count that AI piece. And one can rightly argue, well, why isn't AWS seeing a similar uplift? Well, it isn't because it doesn't have a ChatGPT tiger by the tail. But AWS remains the dollar leader. Azure is gaining share with these AI, OpenAI tailwinds, and GCPs executing off of a smaller base. All right, let's look at some of the spending data from ETR on the big three cloud players. So ETR shared net score data shows it's a measure of spending momentum, and it favors Azure. In July, Azure Post, you can see a 60.2 shared net score, which is off the charts on almost 1,000 shared accounts, well ahead of AWS's 45%, with 784 accounts out of the 1,700 in the data set. GCP below 40% at 36% with 437 responses. Again, that's out of 1,777 responses. That 40% dotted line indicates highly elevated spending velocity. So both AWS and Microsoft are well over that, comfortably over that. GCP is close. So over the last 18 months, Azure has held that level really well. And that's consistent with its AI-driven expansions and this sort of Microsoft ubiquity and their bundle leverage. Yeah, yes, AWS bounced around a little bit, still steady in the mid-40s, and GCP kind of cooled off, but now it's back in the mid-30s, and possibly that reflects bigger and longer deal cycles rather than broad-based expansions. But the net is in these accounts, the wallet share momentum. But remember, this is not a measure of revenue; it's a measure of account penetration. So I should really say the account share favors Azure, then AWS, then GCP. Now, here's a similar slide, but it shows the penetration into the data set. The overlap in those 1,777 accounts, penetration for each. And surprisingly, all three are showing a deceleration in the latest quarter in that pervasiveness metric. So it doesn't necessarily fly in the face of the rapid and accelerating cloud growth rates, but what it probably speaks to is a spending shift toward other categories, namely AI, which is picking up more share, and maybe some pause in AI experimentation in the cloud and some thought of moving toward on-prem or maybe balancing in that direction. Remember as well, we've discussed previously this, I guess I'll stress again, this data doesn't represent spending levels, it represents account penetration. So Microsoft, because it's ubiquitous, it speaks to why Azure's penetration is so high, and AWS continues to broaden its footprint with shared account penetration. GCP is still the third player, quite a distance from the leaders. Okay, so let's close with things that we want to look for going forward, the road to H2 and then 2026 and beyond. Here's the bottom line. As we head into the second half and the 2026 window, let's look at the bull and bear cases we're tracking. There's really who's on the leaderboard. So agent adoption is something that we're looking at. Obviously, power is a big constraint, and silicon. All three of these players, as well as Alibaba and others, are developing their own silicon. Now, if pilots flip into production and enterprise agents start getting embedded across things like Microsoft 365 and Google Workspace and custom apps, we could see a second wave of cloud migration and real productivity gains. Now, for AWS, they don't have a ubiquitous collaboration software platform, but it does have offerings around Q Developer, Q Business. Those are critical for builders to create apps on the AWS platform. Remember, they're three-layer cake. That's the top of the layer. But if customers, if they don't see broad-based ROI and they start suffering from, POC fatigue, proof of concept fatigue, things could slow down. Of course, we're always watching the macro spending picture as well as we reported, it's still pretty cautious outside of AI, referred to our piece. AI budgets are hot, IT budgets are not. We're also looking at the pace of CapEx buildouts and permitting. And so if regulations keep dragging, and I know the current administration is really trying to address that, but if it drags and you still keep hearing that, we're short on power, that becomes the norm, then growth is going to get paced by the lack of kilowatts or gigawatts in this case, rather than being constrained by underlying demand, which appears to be there. So, and the question is, where's that demand coming from? Is it demand broad-based in enterprises, or is it really coming from some of these big foundation model players? And that's not clear right now. I think much of it is the latter. It's the former that's still trying to figure out, the AI play. Well, with the exception of big banks like JPMC and, some of the others that have the skills and the resources to really lean in. But for the mainstream enterprise, they're still really trying to figure out, what to do with all this AI beyond, some of the basic use cases. Now, for silicon designers like these three, if price performance keeps improving, you got Blackwell GPUs kicking in, you got Trainium 2, you got Google's TPU class silicon. So that's going to, the in-house silicon what Dylan Patel, he calls Trainium 2, the Amazon basics of training silicon. I think he doesn't mean that to trash AWS. It's actually, I think, a feature, not a bug. But at any rate, the in-house silicon is going to bring better inference economics and give hyperscales more optionality, and they can keep their pricing power. And this is going to bring along adjacent services and give them a little bit more, flexibility to keep prices, competitive. But if GPUs remain constrained, or customers might be concerned about the all NVIDIA stack and getting locked into NVIDIA and the high training cost, if that persists, that could be a challenge. And so the bear case is migration slow, and customers, maybe pull back a bit. So, that's kind of how we're thinking about it. Is it going to be a headwind or a tailwind? Okay. Sovereign cloud is another area that we're watching. That seems to be a real trend that we hear in RFPs. We hear particularly from overseas players, and it could be a monetization booster. We think Microsoft is a really strong story with its sort of hybrid Azure. Remember the old Azure stack with that footprint? So they've got a legacy business there, and they're using it to their advantage. And so there's evidence, by the way, that Microsoft's non-cloud business remains strong. We've seen some reporting around that. Now, Google is probably even more incentivized to partner for on-prem deployments. It hinted at Google Cloud Next. We haven't really seen it in the numbers yet, but that's something that we're watching. And then AWS, it was interesting at NYC Summit, when we pushed them on sovereignty, they said, look, the original cloud, everybody was all worried about, putting their data in the cloud. Through our, security and virtual private cloud, native capabilities, we can deliver that sovereignty that's required. They have to prove that to local, jurisdictions. And of course, they always have outposts in its back pocket. Policy is, of course, the wild card. We've got this pro-innovation framework with the administration, but, licensing and data use clarity, that's going to support more spending, but broad antitrust tariff shocks or if AI ROI doesn't appear broadly, it creates an air pocket, that's going to cause buyers to tap the brakes. So, but our base case is that pilots begin converting, power, eases gradually, power constraints ease gradually. The custom silicon is going to be there, and it's going to improve inference unit economics and ease some of the GPU constraints. And that sovereignty is going to continue to be in demand, and that will favor, in our view, some of the on-prem players like Dell, like HPE. And so that's something to really pay attention to. They've got to build their on-prem AI stacks out and prove that they can be good enough to compete with the hyperscaler stacks, but that's something that we're hearing from enterprises that they want, because they say the cloud is too expensive at massive scale. And they don't want to move all their workloads into the cloud. They have core mission critical workloads that they do not want to move. But the big concern for enterprises, they continue to struggle with data. Bad data is going to constrict AI payback and agentic adoption. It's just not going to work as promised. Now, that all said, CapEx keeps the lights on and more. It keeps the market humming. And that is the mainspring of all this AI enthusiasm. And look, the Azure playbook, it's popping, it's working. So, hats off to Microsoft. And AWS, they're not standing still. Google's quietly executing and showing improved mix with their margins. So that is all encouraging. Okay, so these are some of the signs that we're watching. Again, agent adoption and how that bleeds it broadly into the enterprise. Weekly active users of ChatGPT is now, I think, up to 800 million. GPT-5 is going to be a winner. As we reported last week on Breaking Analysis, we think that's going to be the first real true consumer agent. And the downloads are cranking, and about 10% of the people pay for it today, according to a recent CNBC survey, and 25% are interested in paying for AI. So there's a market there. And of course, we're looking at token volumes. That CapEx versus real revenue is a big deal. How will they, I mean, right now, if you look at the big three, you're running at 25 billion in revenue, but 240 billion in CapEx. Whoa, big gap. So we're paying attention to that. And then this, how much inference actually gets consumed on non-NVIDIA silicon. That will help ease constraints and will help keep costs down. And then sovereign cloud, the RFP velocity seems to keep cooking. How is that going to shake out? Will AWS be able to convince organizations and governments that its cloud is sovereign? Will it have to roll in outposts? How will Microsoft compete with on-prem and hybrid Azure? What's Google's play there? And what about the on-prem guys? They're in a good position to go capture that sovereign cloud activity. And of course, we're watching any shift in the ever-shifting public policy. Hit on these, and the cloud upcycle is going to run through 2026. That is our base case. That is our expectation. All right, that's it for now. Thanks to Alex Myerson, who's on production and manages our podcast. Ken Schiffman, as well, is helping out with our production. Kristen Martin and Cheryl Knight help get the word out on social media and in our newsletters. And Rob Hof is our EIC over at siliconangle.com. Thank you all. Remember, these episodes are all available as podcasts wherever you listen. All you got to do is search Breaking Analysis Podcast. I publish each week on thecuberesearch.com and siliconangle.com. And you can email me, david.vellante at siliconangle.com, or DM me at dvellante, or comment on our LinkedIn post. Get in touch. And check out etr.ai for the best survey data in the enterprise tech business. This is Dave Vellante for theCUBE Research Insights, powered by ETR. Thanks for watching, everybody. We'll see you next time on Breaking Analysis.